Okay, so welcome again to Casting Strategy Show. In this case, we have Corey Hoffstein. Corey is the co-founder and chief investment officer at Newfound Research. Founded in August 2008, Newfound Research is a quantitative asset management firm based out of Boston. While other managers focus on alpha, their first focus is on managing risk, working exclusively with institutions and financial advisors. He's also the author of many papers and academic articles, as well as the host of the popular podcast show, Flirting with Models. Hi, Corey. How's it going? Everything okay here?
Pleasure to be here. Thank you. Thank you for having me. I got to say that podcast title gets me in quite a bit of trouble. I think there's a lot of disappointed people who go, oh, flirting with models. And then they listen in and it's all about, quant and volatility and factor trading. And it's not what they were looking for.
Well, flirting is interesting because it's something that all of us like to do. So in this case, talking about quant, for me, it makes all the sense. When I first listened to it, I thought, okay, it's an interesting name for a podcast, especially for a quantitative guy, like is your case. So perfect. So Corey, my first question is, what drove you towards the investment industry? Something that I'd like to ask to our guests. And in this case, of course, I want to know about you.
Yeah. So when I was younger, I actually wanted nothing to do with investments at all. Finance was not even something I was remotely interested in. I was very early on, I got interested in technology. I actually taught myself to program when I was around 12 or 13, spent a ton of my time in high school teaching myself how to develop video game engines. I actually used to program video games for my Game Boy Advance.
Oh, man.
So I lived pretty far away from where my high school was. So on a Friday night, if there was, if I didn't have a car and I couldn't go visit my friends, I'd spend my Friday night, writing video games. Then I'd flash it onto a ROM cartridge and plug it in the back of my Game Boy. So
wow.
Not hiding the fact I'm a complete nerd here, but I was convinced that I was going to spend my career in the video game industry. That's really where I had a passion, even though my passion at that time sort of grew out of playing games. I just loved the idea of using programming skill to build a world. And I thought it was such an artistic endeavor. I went to my freshman year of college, university, was studying computer science undergrad and quickly went, I don't think I want to spend my life behind a computer just programming. I didn't particularly like the people I was in my classes with. I didn't sort of share a lot of similar passions with them. And I sort of came to the realization that maybe programming alone wasn't going to be the career I wanted. And so I started branching out and got introduced via my father to some people in the finance industry, sort of spent a little time exploring. So I met someone who did, PE. I met someone who did, venture type stuff, financial advisor, asset manager. It sort of came to say, there's this interesting intersection. This was like 2006-ish, this interesting intersection of what I can do programmatically and some of these discretionary managers I'm meeting. And so that's really where my interest blossomed, was saying, wow, there's all these interesting techniques that they're looking at in ways of trying to measure and forecast returns for the equities they're trying to buy. And wow, I can automate a lot of that for them. And so that's really where my passion took off. And then it sort of just never stopped. So even though it really wasn't something I planned to do with my career, it was sort of a passion that blossomed while I was in university.
Well, I think it makes all the sense, especially in the quant side, because you are programming models. So it's something that has something to do with that. So I understand. Okay, so the next question is, why systematic over discretionary strategies? You have been talking now, especially about these people you were running into and why you decided. I understand this idea of systematic in the sense that you were programming, and that was the first this first approach. Okay, so now in the investment field, what do you think systematic can beat discretionary strategies in your case?
Yeah, so I'm gonna have a couple avenues of answer here. So initially out of the gate, my use of systematic was really more of a tool. So early days when I was working with other asset managers, a lot of the asset managers I was working with were very small and they were discretionary managers. So one in particular was managing separately managed accounts, and he had an investment universe of 400 stocks, and he was pretty much the sole PM. And even if he was trying to analyze a stock a day, he would never get through his entire investment universe. So what it became was the systematic tool wasn't a replacement for the discretionary. It was helping him to sort of cull his universe down into something that he could then, from a discretionary perspective, do a deeper dive, right? So take the 400, turn it into 100. So it was initially more of a tool. I will say for me, behaviorally, systematic aligns more with just how I think of the world. I'm just, again, from the get-go was always a programmer. For me, having the checklists, making sure things are done in a consistent manner, making sure that my own behavioral biases don't creep into the process, all of that just very much aligned with me behaviorally. And so from there, systematic was just a very natural avenue. That said, over time, I've sort of developed an almost philosophical argument. So I'm sure everyone's heard the arguments around, well, systematic helps eliminate all these behavioral biases. And I think there's a kernel of truth to that. But I actually don't think discretionary and systematic are really all that different, right? If you go talk to a traditional discretionary manager, they're going to tell you about their process. They're going to tell you what they're looking to buy. They're going to tell you what they're not looking to buy. Most of them in their slide deck have that like upside down triangle where it like calls the universe and tells you all the things they're. So if you were to sit there long enough as a quant and talk to a discretionary manager, you could, in theory, map out all their rules. Exactly. And anytime there was an exception to those rules, you would say, well, is that always an exception or not? And if it's always an exception, great, it's just another rule. And so you'd sort of take this absurd idea to its limits and you say, okay, every discretionary manager can be turned into a systematic process with one exception. And that one exception are their idiosyncratic decisions. The things that fall outside the rule set that'll never be repeated again. You can't turn them into a rule because it's a truly unique situation. And so for me, I say, okay, every discretionary manager is just a systematic manager plus a bunch of idiosyncratic decisions. So do I think, sorry, go ahead.
No, I just want to ask in this case that do you think the systematic investors don't have this idiosyncratic process? I mean, problems once in a while, even being systematic. I think they can introduce them. I think they can introduce them when they override their own process for an idiosyncratic reason. But if you are truly setting up your process, you have idiosyncratic risk, right? You have process risk and all that. But from the sense of like, are you ever going to do things truly differently? No, you're following your recipe. Yeah.
So I sort of sit there and say, okay, are there certain areas where it might make more sense to value being idiosyncratic, right? Things like merger arbitrage. Well, if each deal is truly a unique animal, then perhaps that's an area where quant alone or purely systematic may be less effective. But other than that, if I say I'm looking at a discretionary value manager, right? Other than maybe them enabling style drift, if I think that's a good thing, right? How to measure value has changed over time. Other than that, I would say, really we're talking about me trying to determine how consistent I think they can be in their idiosyncratic decisions and how much history of those decisions do I need to gain that confidence. So philosophically, again, right, there's sort of the out of the gate, it was just a tool. For me, it aligned behaviorally. Over time, my philosophical view has been, these are not opposite things. No. A good discretionary manager is just a systematic manager who's then layering on some idiosyncratic decisions. The question is, do I want those idiosyncratic decisions or not?
Yeah, it makes all sense, actually, this idea of trying to make a regression of the discretionary managers, and you see eventually that you can find a kind of a process that is, it can be a quantitative process, very, very often. It's super interesting. Okay, so Look, the same question. The next question is, a few days ago, actually, you told me that you did a big overhaul of your processes. Could you elaborate a bit the reasons behind these decisions? Because it's interesting. It's an interesting point now in this situation that you have overhauled the process.
Yeah, I mean, right. The whole point of being systematic is you have a consistent process, and then you completely overhaul it. Sort of defeats the purpose of being systematic, right? For us, what it came down to was we have, for a long time, really focused on trying to introduce new ways for investors to proactively manage risk in their portfolio. So one of our core philosophies as a firm is this idea that risk can't be destroyed, only transformed. And we think about portfolio construction, most investors, and I'm going to speak with a big US bias here, but they typically have a US 60-40 allocated portfolio, and they've been using fixed income as their main means of risk management. Our view and our philosophy was, look, you should not only use fixed income, but you should use things like trend following and pure alternatives and tail risk hedges, and use them in a combination that makes sense so that you are more resilient to whatever future outcomes there are. I always sort of thought of risk like a ball of Play-Doh. And most investors take that big ball and they lump it in one sort of future economic outcome, right? A big, high inflation and low economic growth environment is really bad for a 60-40. And my view is, look, I can't make the Play-Doh disappear, but I can smash my hand on top of it and try to smear it out. And in doing so, I no longer have sort of catastrophic risk in one environment. This is a long-winded way to get to your answer. I promise I will get there.
No, it's awesome.
So as a firm, we always really focused on providing trend following strategies, quantitative trend following strategies. And it said, look, you should do all the other things, but we're going to give you this piece. And over time, over the last 5 or 6 years, we've had clients come to us and say, it really feels like markets are changing. It seems like things are moving faster than they ever have before. It feels like the efficacy of trend following strategies has been slightly reduced. Do you have any evidence to support that? I really couldn't identify anything quantitatively or qualitatively that gave me confidence that markets truly were different. Maybe there had been an unfortunate sort of realized path, but if you considered all the counterfactuals, it didn't seem like necessarily things had truly changed. March 2020, for me, was a big eye opener where I said there was here in the US a large exogenous shock with the COVID crisis, but then what appeared to be a very, very meaningful endogenous shock, that we had huge liquidity issues within US markets that created sort of pro-cyclical catastrophic selling within the markets in a way that I would argue was unjustified. And so after March, I said, there's some mechanic going on in the market that I don't fully understand. I feel like I'm missing a piece of the puzzle, because if this mechanic is at play, then I do think the efficacy of trend following strategies is reduced. Trend following shouldn't do well in a market environment where you get a really rapid sell-off and really sharp V-shaped recovery. So it led to this very deep research project for me. I used to publish a weekly research commentary. I actually stopped and started this very long research process, ultimately culminated in the publishing of a paper that I called Liquidity Cascades. And the ultimate takeaway there was that there are a number of different factors that seem to be at play, from the influence of central banks to the migration from active to indexed strategies to the growing role of volatility contingent players in the market, that have created a situation where it seems like markets move from uncrowded to highly crowded positions. And then if there's a large enough shock, those highly crowded positions make the market very fragile and lead to rapid sell-offs. And so for us, it was great to finally get our arms around this research, but the research sort of suggested, hey, the way you're managing money, you might be offsides here. And by the way, we've been doing trend following for 12 years. So to build your whole firm on trend following for 12 years and then find research that says, well, trend following may have lost some of its efficacy, it's not an easy pill to swallow. But what that meant for us was to, again, with our core goal of simply trying to create resilient equity returns, sort of an all-weather equity type portfolio, we just went back to our core philosophy, right? Diversify your diversifiers. If we think fixed income, trend following, alternative style tilts and tail hedges are the way to go, well, then rather than relying on the institutions or advisors we work with to implement all those pieces. We just went back and said, we're going to reduce our emphasis on trend following, and we're going to incorporate all these other pieces in the portfolio construction ourselves.
Well, this is, I have to say that I've read this paper. I listened to it also through your website. So I encourage people, our audience, please do it because it's an incredible paper. And apparently I got to the same point after reading the conclusion that I got is, okay, it's what he suggests is the idea of blending different assets, different maybe different factors, different ideas in order to try to use different strategies at a time and correlate it maybe one to another. Is this the piece is saying something like that?
Yeah, that really is
strategies and correlated assets, something that can blend this or reduce, smooth a little bit the volatility.
Absolutely. That is. I don't think there's anything new to that concept, right? Diversification is certainly, it's not like I invented diversification. I think, but I do think what the paper suggests, and I do like to be clear, like my conviction on the individual ideas proposed in the paper varies with the ideas. I think the overall narrative, I have high conviction in. I think there is something that has fundamentally changed in markets over the last decade versus 25 years ago. I think that change suggests that the tails of the market are getting larger, both the left and the right. I think you're seeing years like 2017 in the US markets where we had unbelievably low realized volatility and this just slow grind up is just as symptomatic of these issues as a March 2020 is. And so to prepare for both those types of environments, if we're saying we think there's going to be more happening in the tails, then just having a 60-40 portfolio where you sort of have a linear hedge, right? All you've done is sort of reduced volatility might not be sufficient. You might want to start thinking about how we can create convex hedges in the portfolio. And that's something in the US retail investors and advisors really haven't had to think about before.
Totally. Yeah, this thing leads me to towards the next question that I have. In part of this paper, you talk about what you mentioned was about this idea of the passive investment, the race of passive investments. Okay, do you think these systematic strategies and passive investment are killing part of the premium that these strategies per se might treasure, since there's a big inflow going towards them as of late, and it is something that is increasing a lot? I don't know what's going to happen next, but what I do see is that it's being this spread, and it's big. It's turning into something much bigger. And I don't know. Do you think this part of this premium can be kind of erased in some way?
Yeah, I've been joking on Twitter lately that it's sort of this momentum versus the world trade right now. And I look at these two tickers, MTUM and Noble.
Yeah, I know.
Noble's this dividend growth ETF, and you would say, well, why Noble? It turns out it has loadings on value and size and quality and low vol. So it works as sort of the antithesis of pure momentum. And what you are seeing is like every day, it's either momentum, versus Noble, and they have a huge disparity day to day. And this year it's really gone wild. A friend of mine, Josh Russell, posted recently a better statistical analysis where he was actually looking at the diversification available within different factors. And ideally, you would say, look, if I'm looking at all these major factors, I want an equal breadth of diversification across all of them. You'll never actually see that because there's correlation among the factors. But what you've seen lately is that there's zero diversification, that they've all sort of converged into the same trade. So to your question of, is this something that is perhaps because of the growth of systematic strategies, it's really hard to put a quantitative finger on that. I will say that if you look back throughout history, anytime access to a strategy is commoditized, there's an inherent reflexivity upon the market. So for example, when you make commodities easier to access via some sort of indexing program in the early 2000s, it's literally going to change the term structure of commodities futures contracts. So when you say to me, and not you, just anyone, but if you say all of a sudden, we're going to have this huge growth of systematic strategies throughout the 2000s and make smart beta products massively available and see huge, massive inflows into them, do I think that that's not going to have some sort of influence? I think it has to have an influence.
Yeah.
Are they necessarily permanently broken? I don't think I have the conviction to say that yet.
Yeah.
But I do think it has to have an influence. Now, what's odd is you would sort of expect like value is the premier factor, right? And you know, firms like DFA and AQR and all these systematic strategies, I mean, value is what you've really seen the flows go into historically, and value seems to be the one that's most broken. So you have this one narrative, which is, well, if you're buying all these names, wouldn't you expect that to drive the value, you know, stocks up? On the other hand, you could say, well, there's so much money, stock capital that's gone into it. The premium's been totally eroded. You know, so much money has chased the factor that the premium's now been eroded. But it's hard for me to say. I mean, the value spreads have blown out so dramatically. It's hard to suggest that that implies too much money is chasing it. It sort of suggests almost the opposite, that money's fleeing it at a faster rate than ever, driving the premiums away. This is a long filibustery way of me saying I have no idea. It's a really interesting question. I think there's so many angles to this, from you know, just supply and demand theory to thinking about, again, these reflexive impacts of ease of access and how that has to change the dynamics, right? You can't say there's a premium out there and it became easier to access. We can't expect the premium to stay at the size it was. And yet, on the other hand, you can look back at market history and say things go through 10-year cyclical downtrends. This could just be another one of those. It is. Yeah, totally. I'm going to throw my hands up in the air and defer to someone smarter.
I don't know. That's a great question. Okay, so my next question has to do with this idea of, I mean, there's this current of people claiming that the value factor is short in technology, meaning that the value factor doesn't take into account intangible assets. They're increasingly taking over the entire rainbow of industries. Actually, now is kind of happening something like this, you know. So what's your take on this assertion? Because I mean, I've been investing in using the value factor over the last 20 years. I'm 42, so it's something that I've been done many years. But recently we bought a company in the States, actually in Colorado. It's a developing company of AI. So they develop AI. And we have tried to integrate in our models AI, especially because we believe that there's this new platform and we have to try to follow even in our field of work, that is the quantitative side in financial. You know? But in my case, what I find super complicated is how to gauge the intangible assets in the quant field. You know, so I mean, maybe I'm just rounding a lot, but the idea is: do you think that value factor, this enormous drawdown that is happening, has something to do with this idea of the intangible assets, that they're not properly gauged through the traditional way by using value factor investing?
Yeah. So, and here, when I say value, I know this gets a lot of people like feathers ruffled. I'm going to talk specifically about quant value, right? Okay. So not your discretionary value where you could say, hey, like Google was a great buy at a high P. I'm talking about traditional quant value where you're ranking companies on some sort of valuation metric. What is frustrating from a quant perspective, at least for me, is that a lot of people look at the traditional FAMA French factor and say, this thing's been in a drawdown since 2007. What a horrible winter for quant value investors. And yet, if you talk to most institutional quant value investors, they actually did quite well all the way through like 2018. It's really only been the last 2 years that have been really bad. And so the question is, okay, how does that line up? They're all theoretically doing systematic value, quantitative value, but one's been in a pretty bad drawdown since 2007. The other one continued to make new highs for another decade. And the answer is because quants know this intangible issue. They've known about it for a long time. And so there's really no one out there that's just ranking on price to book, at least in the institutional space, right? Folks like Cliff Asness wrote about solving issues like this by, okay, you can either try to literally acknowledge the intangibles, or you can just do intra-sector scoring and just make sure you don't take any sector bets. you can use a composite of factors. So you don't just use price to book, but you use the one that makes sense for that given industry, right? And so you've seen quants adopt these techniques over the last 20 years. And those investors who have said, look, let me do intra-industry scoring, let me use a composite of factors. Maybe I'm going to tilt the weights of certain factors within one sector versus another, depending on which factors I think are more relevant to that sector. You saw them continue to make new highs through 2018. So I guess to say quants don't acknowledge the intangibles, I do think it's a hard accounting problem. You've seen a number of papers that have come out in the last 5 years, but I don't think that was the issue with price to book, but no one uses just price to book. So it's sort of like an argument everyone's having that it's not relevant to anyone.
It's a narrative, something that is, everyone says that they're talking about value as price to book, but this is not really what quants that, So I think this is awesome, this answer to save the value factor.
That said, I do need to put a big asterisk on that answer, which is if you look at a lot of ETFs out there, they are very naive in their construction, right? So you look at something like the Russell 1000 value, which is a huge value benchmark. It does pretty naively just rank on price to book.
Yeah, exactly.
It's got a couple other factors in there. So you do have to be careful, right? There are going to be those that have been tied to this price to book phenomenon. And maybe when you're evaluating if you do want to take a systematic value approach, when you're evaluating options, you want to make sure you look at the methodology. Totally. But most of the more institutional caliber approaches have gone far beyond that.
Totally. Okay, so my last question is, definitely you are very active in the educational field, these kind of papers, tons of articles. So you just at some point, what you are doing is empowering investors through your work, and this is awesome. So what's the benefit of it as per your opinion for both you and your client? This idea of being active all the time and teaching, because this is eventually what you are doing. So what's the benefit of that?
So my role as chief investment officer, I see as sort of being three major pillars, right? There's the research aspect of what I do, which is really diving into the portfolios, trying to figure out what sort of exposure we want, what's the best way we can get that exposure at the lowest cost, reducing transaction costs, all that sort of stuff. Then there's the operational side, right? How do we actually trade this? How do we get all the pipes connected? That's an important element. But the third, which I think goes overlooked by a lot of folks, for me, is communication. I think if you cannot communicate what you're doing in your strategy, it's very hard for investors to stick with it. So I would like to tell you that publishing all this research was, sort of a purely charitable act for me. The reality is it sort of served two goals. One was that we were doing all the internal research anyway. And what I found over time is that if you don't take the time to actually write up your research and memorialize it, 3 years later, you go, did I do this already? I think I may have done this already. And then you go through this labyrinth of folders and you find some code and maybe you wrote something up and you can't recall what you were doing and you end up replicating all the research. Whereas if you had just written it up in the first place, you'd now go, okay, I knew what I did. The code's well documented. And so putting a bow on it from like sort of an internal firm institutional perspective made a lot of sense. And if we were going to go through that step, then I said, well, why wouldn't we publish this externally? As long as there's no like secret sauce here, it helps us from a branding perspective. We're a small asset manager. It helps me communicate with our clients about what we're working on. It helps set better expectations. And then over time, what it's really done is given me a library. So when someone comes to me and says, hey, have you looked at this? I can say, yep, here's the piece. Here's the PDF. Go give it a read. You have a question on how one part of our strategy works? Here's the PDF. We wrote it 2 years ago as to what our best thinking was at the time. Maybe things have changed a little, but that'll give you 90% of what you need to know. And so it's been entirely selfish. All of this publishing of research is just really very selfish. I mean, podcast is the same way, by the way. Yeah. I get to have wonderful conversations with guests that I get to learn from. It's very selfish. And then if I can publish it, other people can enjoy it. Great.
Totally agree.
So for me, like a lot of it is just, it's been that thinking. And the ancillary benefit is, look, it creates some marketing and it gets our brand out there. And if people can enjoy it and learn from it, I think that's great. Absolutely.
Yeah, it's this thing that you said is true. I mean, I'm doing this over the last year, a couple of years, and I have to say that I learn a lot in this area of having you on, and I mean, it's a way to learn. It's a way to be on the way all the time, and trying to learn every day a little bit more. So I do agree totally.
And I would argue both the publishing and the podcast help you build a network, right? We were talking about that, about Twitter earlier, where if you start publishing and people start reading, people will reach out to you. And you'll find out over time that there are people all around the world reading your work, that once you start traveling, you can say, hey, I'm going to be here. Well, now you've got a network of people to meet with. So it's, again, proven over time to be probably one of the most selfish things I've ever done.
I can bet. Okay, Kari. So thanks a lot. It's been really a pleasure, and I think our audience is gonna enjoy a lot this interview. So thanks a lot, and I hope you show up again in another moment, and we can deep down on different things depending on the market, how it's going. So thanks a lot.
Thank you for having me. A real pleasure.
So thanks everyone for tuning in and for allowing us to do this kind of interviews with US investors. We are enjoying this kind of work significantly. As Corey is saying, we are learning ourselves, so we are selfish in that we are doing them, of course, as well, hoping that you, the audience, can benefit from them and can enjoy them. So if you like the interview, remember to subscribe to the channel and to give it a like. See you on the next episode.